Hello and welcome back to Financial News and Your Money. Today is August 24th and I am Paul Munichel with Ameriprise Financial, and Ron Jankowski is off today, so I'm going to be doing both his parts and mine of today's show. And normally I start out off the show giving you some economic ideas to think about and how they affect the market. Today's topic is going to relate to GDP and its reference to the economy. So let's go ahead and begin. The recent goods-related GDP data could indicate the economy recovery is strengthening. The resurgence of COVID-19 cases in Q3 of this year is weighing on the pace of economic recovery. However, we are encouraged by recent improvement in the goods-related GDP data, which historically has been a leading indicator. We can illustrate the historical relationship between goods-related GDP and railcar and intermodal container traffic. These two data points exhibit a 95% correlation, which means for the most part they do move together. The confidence we are drawing for on improved Q3 goods-related GDP comes from the following reading, which shows the 6-week moving average for rail cars and that intermodal container traffic improving. While the pandemic derailed rail traffic in the first early part of the year, the rolling 6 weeks averages to start the new quarter are particularly encouraging, especially as it relates to the potential on the goods-related GDP. So, in short, if GDP is improving and on the goods-related sector, that could be a sign that the recovery is strengthening. So, potential good news there. Some market data points for today, again being Monday, August 24th. We're looking at U.S. equities are starting higher on Monday morning, aided by positive developments in the COVID-19 treatment front. Meanwhile, stocks in Europe, they're sharply higher, with the major benchmarks in France and Germany each higher by more than 2%. So that's great news for our global economy. The yield on the 10-year Treasury is flat at 64 basis points, while gold is higher to a near $1,964 per ounce. Shares of AstraZeneca are higher as the Trump administration considers fast-tracking a coronavirus vaccine candidate from the drug maker. So all points that are leading to a stronger market, at least early on Monday morning, and we'll see how the news comes out and how the market continues to perform as the day goes on and the week goes on. That's going to conclude the first half of the show, the financial news portion of the show. I will be right back with Your Money, with a topic related to specifically to your investments. So stay with us and we'll be right back. Hello, thanks for staying with us and welcome back to the Your Money portion of the show. And in the first half of the show, something Ron usually does is give the year-to-date numbers on the stock market, the three major indices. I forgot to do that, so I'm going to go ahead and do it quick now. These are all year-to-date percentages. So the S&P 500, and this is through Friday's market close, S&P 500 is a positive 6.47%. The Dow Jones Industrial Average still negative, but only by about 0.5% year-to-date. And the NASDAQ is a positive 26.93%. So we still continue to see the large gain in the NASDAQ stocks versus the other indices. Something that, as of today's market open on Monday, it looks like that trend may continue. Who knows for how long that will continue, but as of now, the NASDAQ is continuing to outperform. Let's move on to the Your Money portion of the show. And today we're going to talk about how the recent market volatility caused by the COVID crisis, how that specifically affects kind of the pre-retirees and the post-retirees and their investment portfolios. So let's go ahead and begin. Retirement is an important milestone that often comes after years or even decades of careful planning. But even the most seasoned planners couldn't have foreseen the severe market sell-off that happened in March in reaction to the COVID-19 pandemic. The abrupt end to the 10-year bull market surprised investors of all ages and who are now wondering, given the current recovery, how long that recovery may continue. So there's lots to be aware of, a lot of volatility, and a lot to follow when you're investing in the stock markets. Unlike younger workers with many years ahead of earning and saving, investors who are retired or nearing retirement have less time to wait out their losses. But there are still actions they can take to help secure their finances, even during periods of uncertainty like we're experiencing today. If this situation applies to you, here's a few steps to consider in this new volatile environment. So let's begin with if you're approaching retirement. 1. Pick your retirement date. If you haven't already, take time now to decide the year and the month when you plan to or potentially plan to retire. Given the current environment, you may want to consider extending time in the workforce, whether it's continuing your current career or moving into a new full-time or even part-time position. Either way, your answer can have a big impact on your investment decisions from this point forward. Point number 2 for the pre-retirees, ensure that your investments are diversified. Not all solicitors of the economy are alike, and they react to news and events differently. For those nearing retirement, the recent spike in volatility is a reminder of how having a broadly diversified portfolio can potentially help reduce your investment risk. Instead of simply selling your stocks in an attempt to cut your losses, review your portfolio to see if it's properly balanced between stocks, bonds, and cash that align with your goals, time horizon, and your ability to manage risk. While a diversified portfolio can't guarantee profits or protect against all losses, it can greatly reduce the impact of volatility. And the third and final point for the pre-retirees, balance your need for protection with growth. Protecting your portfolio from market downturns becomes more important as you approach the day when you start to live off your savings. During this time, you may want to consider investing the money you plan to use for income in the first few years of retirement more conservatively in liquid vehicles that are easy to access. This can give you peace of mind that you are prepared to handle upcoming expenses no matter what's happening in the current market environment. All right, let's change gears and let's look at the individual that is currently in retirement, and let's look at 2 points that they should be aware of. 1, review your withdrawal strategy. I can't emphasize this one enough. If the recent decrease in the value of your portfolio makes you nervous, revisit the amount of money you withdraw to meet your expenses. As you review, the goal is to be assured that the amount you withdraw is enough to meet the next year or two of expenses, does not put your long-term financial security in jeopardy. If your base of assets is reduced, you may have to trim your withdrawal amount to assure you have a sustainable long-term income strategy. That's one people really need to be well aware of, is potentially adjusting your withdrawal amounts due to your market balances. Point number 2, don't take unnecessary chances in your stock exposure. For the long-term investor, which may include you as a retiree, volatility in equities can work in your favor. It's possible that you will spend 1 to 3 decades in retirement, giving you time to withstand some market moves. At the same time, it's important to preserve your base of savings and not be overexposed to stock risk. Now is a good time to review your exposure in the context of your full financial plan to evaluate if you are taking on the right amount of risk. Additionally, focus on your equity portfolio on higher quality stocks. Maybe look at blue chip stock companies that tend to demonstrate more stable performance. Stocks that pay competitive dividends may also be an effective choice to provide a source of reliable return on your investments. In general, if you are concerned about the recent performance of the markets and the impact it may have on your retirement, consult with your qualified financial advisor to determine what steps might be right for you. And of course, if you are not working with a financial advisor, or if you want a second opinion with the person you are working with, feel free to give me a call directly. You can call me at 708-226-3412, and I'd be glad to help in any way that I can. That's going to go ahead and conclude today's show. Thanks for staying with us. Thanks for watching. We will be back next week with a new episode of Financial News and Your Money, some updates on the markets, and a new topic for investment considerations. So again, thanks for staying with us. We wish you a good week. Stay safe, and we'll see you again.